Hello everyone, it's PJ Patterson here for a market update on Monday, the 30th of November. Hope you had a great weekend. It was a scorcher here in Sydney for those of you who are here in the Sydney area in New South Wales. What a ridiculously hot weekend. I spent most of it in the aircon because sport, which doesn't happen very often, but sport in my area was postponed because of the heat. So obviously looking after the youngsters and the oldsters alike playing sport. Anyway, to get on to our top three things today, just before I get on to the top three things, last week was a short week of trading due to the Thanksgiving holidays in the U.S. And so whilst I don't celebrate Thanksgiving anymore because I live in Australia and we don't have Thanksgiving here, and I've lived here now 22 years, I think, this year, I do want to say absolutely to all of you, I really appreciate your business. I thank you for supporting my business. I'm grateful for all of you who are my clients, the wonderful commentary that I get from you, the ideas, the banter, the debates we have about various things. And I really do appreciate that you are supporting me and my business. And I promise you that I continue to work every single day to increase our wealth, because I invest alongside you guys as well, but to increase all of our wealth, to protect our capital, and to get better and better every single day that I can in this game of money management. And so again, I thank you sincerely for that. Not long now till Christmas. We are at the 30th of November, and we're looking at the wind down period here in Australia. So we'll see how that goes this year. The initial reports on our Black Friday, Cyber Monday, Cyber Tuesday stuff is very positive. So one of the things, and I'll touch on this in a moment as I go through what will probably be a fairly brief update today, that retail sales and consumer discretionary spending is one of those areas that Quad 2 in particular is where you want to be invested. So I'll cover that off in just a moment. Anyway, top three things today. First and foremost, our good friend, the US dollar. Going to keep talking about that probably until the cows come home. The second thing is sort of the VIX and this ongoing conversation around the VIX that I have with you, and just highlighting where that's headed, where it's at. Not just the VIX, but the volatility measures across a number of asset classes. And then finally, going to just talk about growth and the prospects for next year, and just to iterate where we are. Now, one exciting thing I'm going to let you know about up front is I'm going to begin relaying to you some of the key quarterly investment updates that I get from Hedgeye. And there's some very, very powerful stuff. Every quarter they do an hour long or thereabouts presentation on all of the thematic things that many of those things I touch on a weekly basis in these market updates. But they also spend a lot of time talking about the whole global macro environment, specifically the key economies around the world, like the US, like China, like Europe, and where they're headed. They'll invariably touch on smaller regions like Australia and how to be invested for those regions and where those regions are going in terms of the quads, and really just give an overall fantastic filter and perspective on what is coming in the next quarter to 2 quarters out, and sometimes even longer. So that's going to be effectively what I'm going to call now a monthly update, which I will do right around the beginning of every month. It depends on some timings and obviously when the first of the month falls. But my commitment to you is that I'm going to give you sort of that month-long review of what's been going on. And in that review, I'm going to look at the positions and the things that are being held individually in accounts that are across the board. So some of you have other stuff that you have chosen to buy in your own accounts, and that's fine. I won't talk about those positions, but the stuff that I am positioning in your portfolios and in your accounts, those will be across everybody's account. So I'm going to touch on those positions and delve a little bit more deeply into why those positions are on and what they mean for your portfolios, and then just sort of delve into that. So that's going to be the monthly update. So look out for that coming through on the boardroom and also through your individual emails as well. So let's move on to our good friend, the US dollar. So actually, I'll just move this that way and that way. So once again, we are seeing, and I want to, and I will continue to highlight this because, again, if you get the direction of the US dollar right, you're going to get a lot of stuff right in global macro. And this is so important because the dollar drives so much of what goes on around the world. And if you understand that and you invest accordingly, you're going to make money. Invariably, you're going to make money. So once again, I want to highlight the fact that and point out a big change in a correlation, which you've probably already spotted. But we have the inverse correlation, which once again, for those of you who are following this, the inverse correlation, the closer it is to a -1, so 0.95 plus, it pretty much means that if the US dollar rises, these things fall. If the US dollar falls, these things rise. And then I suppose if you look at sort of a correlation of 0.7 or higher, that's a pretty strong correlation. Really 0.5 or higher is a pretty strong correlation, but the closer it gets to that -0.99, that shows you a very strong native correlation, as I just explained. So over if you look at these timings, over a long time frame, you can see that there's a strong native correlation across all of these asset classes. As you come back a little bit in time, and these are the last 180 days, 120 days, 90 days, etc. As you come back to more current, the more current period, so the last 15 and 30 days, you see that some of these things have decoupled. So by that I mean, and specifically, if you haven't spotted it already, gold, which many of you know, I have been a gold, I don't call myself a gold bug, but I've been a big believer in gold and silver for a long time. And to be honest, and I'm happy to share this with you because it means I've gotten better at what I do, is I understand now how gold fits into the global macro environment and what truly impacts gold. And it isn't some of the stuff that you hear on a lot of these media sources. It's actually really it's the US dollar and its interest rates. These are the two things that really strongly influence gold. And interestingly, there is now we're seeing it actually happening. Interest rates are rising in the US. So by interest rates, I mean the US any sort of rate across the US Treasury bill and Treasury bond or Treasury note curve, so the 2s, the 10s, the 5-year, the 30-year, etc. They are the rates on those are beginning to rise, which means bond prices are falling. So this big bull market we've had in bonds over the last better part of probably 15 to 18 months is probably now over in the short term. At least it will be for the next couple of quarters because, again, we're entering quad 2 and fixed income. And I'm going to show you a table in a minute, which again, I'll probably delve more deeply into as it relates to the monthly update, but I'll show it to you in a moment. But fixed income gets absolutely torched in quad 2. You simply don't want to own it because bonds are losing value as interest rates rise. So you don't want to be owning those suckers in a quad 2 environment. Anyway, as you can see here, the inflation that I've talked about, or the fact that we're seeing inflation, is beginning to show up more and more in the commodities index, in the oil price, and of course, we're also seeing that actually in Bitcoin, things like Bitcoin. For those of you who invest in the cryptocurrencies, this is probably one of those times where you certainly want to own Bitcoin. Don't know about any of the other currencies, don't really follow them that closely, but Bitcoin certainly has more upside potential from here. And it's an asset that you could very well own. And if you are a Bitcoin investor, and I don't want to spend too much time on it because I don't buy it, although there is a company that I'm looking at putting on a position in that owns something like $500 million worth of Bitcoin. So as Bitcoin moves, this company's share price moves. Anyway, as I say, I'm not going to delve into that today, but I'm looking at putting on that position. In any case, other things like gold have I shouldn't say other things like gold. Gold and silver have decoupled from this relationship that we saw over a longer period of time. So again, this is one of those key measures that you want to watch. As the US dollar now rises, the gold price will rise. And as the US dollar falls, which it's in a bear market, guess what? Gold price, silver price are going to be falling. So long and short of it is, miners, gold miners, and gold are a no-go zone for the time being. And interestingly enough, I got out of gold and gold miners very recently prior to the beginning of this decline. So a big pat on the back for me, but it's because global macro works. This shit actually works. So that's good news. Anyway, moving on to our next point, which is the VIX. Now, I just wanted to highlight the VIX. I do spend a lot of time talking about the VIX. Again, it's another key component of the timing that is necessary to be a successful investor. And this is something that a lot of professional investors that I've noticed simply don't get. They just don't get this relationship. They don't understand that when volatility is above certain levels, you cannot invest in that market. You must move to the sideline, or better yet, put on some protection, or better yet, buy the things that do well when there's a lot of volatility in the markets. But the good news is that volatility now has come down. It's begun to really roll back to those levels that we saw prior to the COVID, prior to really what the market was doing sort of late last year and the beginning of this year, which was beginning its decline. But we've seen volatility, and here again is a chart of the VIX. I'll just see if I can get this a bit more on the screen for you. Chart of the VIX. You know, we've gone through a couple of big spikes and a couple of big roll-offs. Now, this big spike up in here was the COVID crash. Just see if I can get that into light. So we were, you know, this is the S&P 500 VIX. We were sitting around an average of probably somewhere between 11 and 15, which is absolutely all day long. And I mean this with no disrespect for those of you who like to pick stocks and stuff, but any Muppet can invest and make money in a market where the VIX is 15 or less. Anybody. It doesn't require any skill because the whole bloody market's going up. So everybody goes, oh, I'm making all this money, but they don't know why. But one of the main reasons is because the VIX is so low that money just keeps pouring into the market. When VIX does this is where every Muppet loses their money, who thought that they could invest down here and they were geniuses. They get absolutely crushed in an environment like this. Now, if you recall, just in the lead-in to this, started to reposition for things that are beneficial when volatility rises, repositioning into treasuries and such like, and I didn't get my head handed to me, my face ripped off when all that volatility began. Neither did you. And this is an important lesson, and I probably will never say it enough. But and I don't mean to sound arrogant when I say this, but you should be thanking me that you have been introduced to this concept, because it's going to save you and me a lot of money in the long term, because when volatility, again, goes to certain levels, it's a no-go for markets. And commensurately, and this is really where I'm headed with this, and it flows into point 3, is that when volatility comes right back, it is an absolute green light, open door, open gate to push all of your cash into the market, as long as you know where to position yourself. And so, again, that's where the monthly update is going to delve a little bit more deeply for you into positions and give you a better understanding of what we own and why. But just to flip back to this presentation here, this slide deck, I want to just find a slide that I had it a moment ago. Where did it go? Sorry, give me a moment. There it is. This is the slide that I'm going to spend more time on in the monthly update. Now, I'll just draw your attention at this stage anyway to the quad 2 reflation column. And quite clearly, and just so you know, this has been back tested and it has plenty of evidence to support exactly what this is telling you on this slide. This is not a feeling. This is not a guess. This is based on empirical data from markets. And so clearly, as I mentioned earlier, fixed income is a no-go zone in quad 2 because we're seeing reflation, we're seeing inflation coming into the market, and the bond market knows this, and as such, the bond market begins to reprice itself, and that's exactly what's been going on. So you do not want to own fixed income. US dollar is another one that you don't really want to own outright. Now, there's a couple ways to play that, which again, I'll talk about a bit more in detail in the monthly update. But having said that, I have begun, or did begin about a month ago, to start moving some cash back into Aussie dollars. Now, this is going to play out over a long period of time. So I don't know where the Aussie is going to go. Ultimately, it's trading around 74 cents to the dollar today. Could go to 80, 85, 90. Who knows? It's an unknown quantity at this stage. But What I do know is the US dollar during this quad will be continuing its bear market. Then you look at some of the best equity sectors, and then there's this other thing called style factors. I'll just delve very quickly into that. So obviously the best equity sectors to own are these. So tech is a biggie. I've been talking about that for a while. Consumer discretionary is also very important. And the reason for that is people are now, this quad two scenario is where we start to see growth again. People will begin spending again. They'll go out and buy whatever, trinkets and everything else, right? So it's that period in the economic cycle where consumer discretionary stocks do really well. That's the same for quad one, but certainly quad two, they're a biggie. And then industrials and materials. So things like your industrial stocks, pretty much. Look, let me put it this way: you can almost throw a dart at the stock market and make money. However, there are some sectors you don't want to own, and those are noted there as well. Probably because they underperform relative to the others. So it isn't that they're bad per se, like they aren't going to just flat out necessarily decline, but they're just not going to go up as much as these other sectors. So these are going to be the best performing equity sectors, as noted here. And there are others, but they will be some of the best performing equity sectors. These will be the worst. And then you have other factors within those, within those sectors. So when we talk about things like secular growth or momentum or growth stocks or small caps, those are subsets of these other things. So you could, for example, have your tech stocks like your Amazon, Google's, Microsoft's, probably not Microsoft so much, but Facebook would be a better example where they are the secular growers, right? These are companies that are still in their massive growth phase, sweet spot for that, as opposed to old tech, which might be, like companies like, what's a good example of old tech? Maybe a Microsoft, because they're a very mature company, or a Intel or something like that. So certain sectors of tech, like microchips and some of those would not be areas that you'd want to go to. Anyway, finally, then you have better fixed income sectors. So even though fixed income is a underperforming asset class, there are sections of fixed income that perform better, and that's because they have different attributes than, say, government debt. So you're talking about things like these convertibles, preferred loans, credit, this sort of thing. So anyway, that gives you a little bit of a primer. And again, I will go through that in more detail because I'll have all of the positions lined up next to that to show you how we're positioned in quad two for reflation. So that's really all I wanted to cover off today. Again, a short update because we had a short trading week last week. Markets are still, I think, trying to find their feet around the COVID resurgence in the U.S. and, of course, the ongoing presidential election issues with Biden. Now, it's squarely looking like they're doing the transition, and Trump's camp has admitted that, not admitted, but accepted, I suppose, that he did lose the election and is moving on. So interesting times await us in the new year, and there's still 30 days left in this one, so we're not going to take our eye, off the ball. I don't know how many trading days there are left. Probably something like there'll probably be something like 20 to 22 trading days left in the year. So still plenty of water to flow under the bridge this year in 2020. And again, I'll be keeping my eye on the markets. But for now, all of the things that I've been reinforcing over the last, probably 5, 6, 7 weeks in terms of market positioning are absolutely playing out. And just finally, one of those key areas is Asia, which continues to show strength and will continue to outperform. So I'm talking about South Korea, Japan, Taiwan, Indonesia, China, of course, and Australia too. I mean, we are in the Asia Pacific region, probably New Zealand for that matter as well. And so that's it, I think, for now. I will talk to you again maybe at the end of this week. We'll see what happens when trading resumes full-time overnight on Monday. And then I'll either leave a market update this Friday or this coming Monday. Anyway, hope you had a great weekend. Hope you're looking forward to a great week, and I'll talk to you soon. Bye-bye.